Hey there guys, this is Ron again. The lesson this week is about cash flow management, which is a subject near and dear to my heart because I spend a lot of my time on it. And I will tell you that cash flow management or mismanagement will be the difference between whether you make it in business or whether you don't make it in business. And obviously when most businesses close, this is because they don't have the cash flow. And if they don't have the cash flow, it can only be caused by a few things, but I'll tell you what, mostly it's caused by their inability to do step one of my 5-step program. Now, if you've been watching these videos, you should know what my 5 steps are, so let me just run them down real quick. First one is to locate prospects. Second one is to pre-screen them. Third one is to construct and present offers. And the fourth is to close quickly. Now, of course, if we don't do number one, locate prospects, then we're going to have cash flow problems because the other 4 don't matter if we don't have any prospects to work with. In the case of real estate, where we're buying and selling houses, we got to get sellers calling us on a consistent basis. And I'll tell you right now, that is the first thing. If you could fix that, if you can get that first thing fixed so that those sellers are calling you on a consistent basis, there's a good chance you won't have cash flow issues. We have to have the prospects coming to us so that we have some deals to work on, to pre-screen, step 2, and make sense out of, so that we can get an offer out there or accept the seller's offer to us, because most of the time when you're talking to FSBOs, for sale by owners, you pretty much know what the offer is as soon as you read the property information sheet. And you either accept their offer or tweak it a little bit or just totally deny it. But it starts with getting them coming at us. Now today we're having our virtual assistants call FSBOs for us so that they consistently come across our desk. And then you just follow those to a conclusion. And it'll take a little bit of training. I strongly suggest you get to my Quick Start School. In fact, I've got a couple of them coming up here before the end of the year, as fast as you can, so that I can show you the beginning to end process step by step, so you can see how to get to the conclusion without having this great big cloud in the middle that blocks you. And if you can go through that process and implement those 5 steps, cash flow will not be an issue because it'll constantly be coming at you. Now, we're not going to fix cash flow by doing an occasional deal. It's nice to have a check every now and then, but it's more important that we have consistency and an ongoing flow of cash coming in. Now look, I can tell you that most people manage their business from their checkbook. And here's one of the biggest mistakes that I see people making when it comes to cash flow. First, they have no idea what their monthly break-even is. When we do my business management class next year, one of the things that we're going to do is go write down a list of expenses from several business owners in the room, and we'll find out what each individual business expense is for them. And the whole purpose of that exercise is to figure it out by totaling it up, what our total nut is, or what our total operating expenses are for that month, at least the best we can predict it. We take fixed expenses and we add it to projected unfixed expenses. And one of those fixed expenses, of course, is what you take out of your business, because as far as I'm concerned, you pay yourself first, not last, and you are going to be a large expense to your business, and you hope that expense only gets larger and larger and larger. But if you put 10 people up against the wall and asked all 10 of them what their monthly break-even is, it's a good chance none of them will know the answer. Most businesses don't even know what it takes to keep their doors open for a given month, so they have no idea when they're crossing the break-even point, when they're actually making any money, and they just keep operating out of their checkbook. As long as their money's in the checkbook, they think they're making money, which nothing could be further from the truth. Your check could be full of cash and you still be losing money. Or the opposite, they think because the checkbook is broke that they're not making any money. Also, nothing could be further from the truth. You have to know what your break-even is. Then you can project when you've arrived at that for that month, and you will always have that number in your mind, so you'll know how you're going along the way. If you, in the case of real estate, for example, I got my operating account here. This is the account that pays my operating expenses, my gas, any employees, my virtual assistants, my telephone, my utilities, and all of that stuff to operate my business. Well, if I take that account and I start writing checks out of that account, for example, to buy a house or renovate a house, that I'm taking money out of my operating account that I shouldn't be taking out. That money needs to come from elsewhere to buy or renovate a house, so I'm not robbing Peter to pay Paul. If I know I need $10,000 a month to break even, and I'm sitting here with an account with $10,000 in it, and I go write a $5,000 repair check, well, I'm just digging my own hole. I'm creating my own cash flow problems. So you got to carefully watch what it takes to break even. Where am I going to get that money from? What do I have to do this month to make sure that my break even is taken care of? At which point there I'm making excess capital that I can use for other things. If I'm going to renovate a house, or if I'm going to buy a house and pay cash for it, I need to know where that money's coming from, and the answer better be private lenders, not out of your operating account. Now granted, when you get enough cash ahead, and when you're way ahead of the break-even game and you feel comfortable that you're okay to use cash, I can't think of a better thing to do with it than write a check to buy a house, pay cash for it, as long as you intend to get out of that house and get that check back quickly with a larger check. The worst thing you can do is leave capital in real estate long term. Every dollar that you leave in a house long term is a dollar that you cannot use to make money with for the whole time you own that property. Your rate of return is going to be your total return on that property is going to be the same with or without your cash in it. Property is going to grow the same value with or without your cash. So if that's true, then why leave your cash in it? Just remember this. If you invest, I don't know, say $10,000 in a piece of property for a down payment, and it's 10 years before you sell that property or refinance it or whatever, that's 10 years. That $10,000 wasn't making you a nickel. If you learn how to buy that property without using that $10,000, now you've got that asset creating wealth, probably cash flow and growth for you without tying up your capital. So you can now take that $10,000 and invest it in other high-yielding, high-rate of return investments, such as making loans with it or all the things you can do with cash. So just never confuse tying up cash long-term with real estate. Real estate is not supposed to have your cash tied up into it. It's the vehicle that creates cash so that you can then take that cash and do other things outside of real estate with it, or inside of real estate, such as buying houses, paying cash, flipping them, and getting that cash back with a bigger check. So anyway, we got to know what our break-even is. We have to figure out how we're going to get to that point so that we know when we're breaking even every month, making sure that we pay ourselves first along the way, because a business where the boss is not getting paid is a business that sucks. I can tell you that right now. Make sure the boss gets paid. Everybody else can wait. Boss comes first. Other cash flow problems is people spending money that doesn't belong to them. They spend money out of their account, and just because the liabilities haven't arrived yet, just because you haven't got the bills coming in yet, does not mean that that's your money. So be very careful about taking money out of an operating account and spending it for something that it shouldn't be spent on, convincing yourself that, well, that closing will come up soon, that money will be replaced, or whatever you're trying to convince yourself that may or may not happen. I'll tell you this much, the worse you need the money, the less chance you got of it showing up when you need it. So anyway, that's enough for today on cash flow management. That's a good start. We're probably going to have to be talking more about this in the future.